Welcome to the FarrCast, bringing you insights into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the 14th day of March, which means tomorrow is the Ides of March. Always just remembered the Ides of March. Don't know if you do. Didn't work out well for Julius Caesar on the Ides of March. Was talking to a friend, just by the way. I used to teach high school English, as many of you may have heard me discuss from time to time. In Dante's Inferno, at the very pit of hell, the worst of all sins, and also the most violent word in the English language, according to Robert Frost, is the word betrayal. Betrayal. So Satan betrayed God, and he was at the bottom of the pit, and Satan chewed with three mouths, Judas, Cassius, and Brutus. So those three betrayals in the mouths of the ultimate celestial betrayer always fascinated me, always ticked off on the Ides of March. And for those of you who have ever been betrayed, it is a pretty awful feeling, particularly the closer the friend and the closer the betrayer. I can tell you one thing. If you want to make sure that you're never betrayed, make friends with Jim Lebenthal. That's it. That's it. You make friends with Jim Lebenthal, you've got a really good friend. And that's one, you don't even need to watch your back on that one, because Lebenthal will take care of you. He's our first guest today. As we look at what's going on stocks, they are making new highs. Yields are bumping higher. Inflation is coming down, but perhaps even the rate at which it's coming down is flattening a little bit. Geez, you can't really count on anything anymore in markets. They won't go straight up or straight down, especially when you want them to. Boy, maybe there's where we should engrave that somewhere. They never go straight up or straight down, especially when you want them to. Valuations are high if the rule is buy low and sell high. This is not low. This is not near low. Not near low. Everything that drove markets at the end of 2023 has driven markets still higher in 2024. The dollar has gotten a little bit weaker. Cryptocurrencies going through the roof. Crypto going through the roof. $73,000 for Bitcoin. One Bitcoin, $73,000. Ether, right around $4,000. Ethereum. So that's the nature of things. Earnings weren't bad. Everybody wants the Fed to cut. There's a paradox here, folks. Even the talking of cuts has people wanting to buy and spend money and creating demand. So with an economy that's still continuing to thrive and unemployment below 4%, what's the problem? Why do they have to ease? So complacency, I think, is the greatest risk for investors right now. It feels good when it goes up, and you need to be cautious about how you're deploying capital and how you're keeping capital deployed in things that have gone up a whole lot. Jim Lebenthal is a partner at Sarity Capital Partners. He is a CNBC contributor, and he's the guy you've got to take it off of mute and listen to every time. Welcome back, Jim.
Good to see you, Michael. Folks, thanks for having me on again. We may need to all go down to Naples, Florida, and give Michael a hug. That intro, I don't know. I don't know who hurt you, Michael, but I'm going to get him, okay?
See, that's how you know he's got your back, folks. Right there, baby. That's it.
Betrayal.
Well, I've been betrayed by markets before, I can tell you that.
I understand the setup. I had to make a funny out of it, though. At the end, though, complacency. That is, it feels like it right now. Pretty complacent. We're just la-dee-da. The market goes up. The tech bellwethers continue to go up. There's one sort of saving grace, and to me, it's pretty important. The broadening of the market. I'm really feeling it. If you look at something like, and I know we're not supposed to talk stocks, but I'm not making a recommendation here. If you look at NVIDIA, of course, it's up whatever it is, 50, 60% year to date, and everything else pales by comparison. But if you look at other sectors, industrials, financials, materials, even energy starting to show life. I mean, there are good returns through the first 2.5 months of the year. And outside of the tech bellwethers, which are promoting not only the market's rally, but the inflated valuation. Outside of that area, there still are attractive valuations relative to growth rates in those non-tech sectors that should continue as this economy continues to expand on the back of a strong labor market. So yes, complacent. I do think there will be a correction at some point soon. I never try to time. Yeah, I never try to time them. And folks, you shouldn't try to time them. You never know the hour at which it's going to come. And you never know how long it's going to last. So even if you manage to time the beginning of the correction, then you've got to hit that landing twice by knowing when to get back in. It's so hard to do either, let alone both, that the best thing to do is ride through a correction. I do not see, now I hope this is not famous last words, Michael, I'll let you respond to this. I do not see the makings of a bear market because I simply don't see the makings of a recession.
I don't see the makings of a bear market because I don't see the makings of a recession. That is a really important point, Jim Lebenthal, ladies and gentlemen. That's what you want to listen to. And because if the underlying economy holds together and remains on a positive trend, is able to continue to expand at any rate, you shouldn't see a recession. That's just a fact, just a fact. So, Jim, you know, I wish I could be as noble as you are and not try to time these things, because I always try to time them. I just try never to do anything about them. But I'm always trying to guess and second guess in my head. I'm just really trying not to move money. But help me think through this. When it comes to stocks, I have been looking at a couple of stocks. I've added some in the past year, but there's a stock or two I would like to buy right now. One of them is down 40% on the year. It's got an A-rated balance sheet. It has missed out on maybe some of the hotter things going on in its own industry, but it has a lot of potential things in place. It's acquired a bunch of things that could hit, and I'm saying, all right, down 40%, it's up a half a point, it's down a half a point, it's moving here and there, but it's still near those lows. And I think, and it's got a great dividend, 6% dividend. And I think, well, I'm just going to put some money in there and I can wait with 6%. And then I think, geez, market's still at an all-time high. That stock, I don't think, is going anywhere fast. I'm not buying, I don't trade, much. So if I'm really making a long-term balance sheet investment off of potential for growth that I see fomenting, do I need to do that anytime fast, or should I just sit on my cash and earn my 5% in money market?
I really like what you said, Michael. And, it speaks, the way you started that is kind of, should we time a correction? And I think we're both going to agree that we shouldn't. However, the process by which we buy and sell stocks, they don't have to go on at the same time. What I mean by that is the other day I trimmed one of my semiconductor holdings. The semiconductor space has gone fabulously well recently, and my exposure to it was simply too high. So I cut back on one of the names. I trimmed it. I did not immediately go put that money to work. And I think this applies to the pharmaceutical company that you're speaking of. I'm pretty sure I know which one it is. And just nod, blink twice if it's a pharmaceutical company. Yeah, and folks, you can't see it, but he's blinking twice. The thing that you do once you trim or even sell outright a name, you don't have to put every single dollar back into the market, particularly at this level in the market. So just, make a pattern, make a decision. Every week, I'm going to buy a little bit of whatever stock it is that you want to own. There is seldom a time where I go in whole hog on one particular name. And I'm reminded in this conversation of something that an old mentor said to me probably 30 years ago. He said, we sell securities, we buy insecurities, meaning we don't really know a stock as well when we're buying it as we do when we're selling it. When we're selling it, we pretty much know everything there is to know. When we're buying it, we're still kind of finding out. So quite often when I'm buying something, I take my time. And that lesson is writ large when the market is in this state that both you and I, Michael, think is complacent.
I think buying a stock is a lot like hiring somebody. It might even be for our younger friends, or perhaps some of our older friends out there, like when you're dating someone early on in a relationship and everything just looks great. When you buy a stock, you really try to make yourself look at the risks, and we really do. And we do look at the upside and the downside, but such a huge part of the upside and such a huge part of hiring someone is that story you've created in your mind for that person. It's that narrative where you filled in all of the blanks, and optimists inherently fill them in positively. And then we learn to live with disappointment as the road goes, as you go down that road. Gee, well, I got that one wrong because I thought, and yes, now I see I was projecting my own positive, rosy view of this situation. Occasionally, you really do get it right. Occasionally, it really works out very, very well, and we make money and hope to let those profits run. But this is also part of the discipline that when you're thinking about committing money to a new name, can you temper your enthusiasm, and how much of your enthusiasm is driven really by what you would really like to have happen when you start down the road of selling yourself? Jim, when you take on a new position, you say you don't go in whole hog. What's whole hog for you? What's a full position? What's a half position? How do you manage and diversify within your equity portfolio?
Yeah, I really love that question. I do run a concentrated portfolio. I try to hold 25 stocks plus or minus two or three, but 25 is really the target. That's much more concentrated than most managers will run. Now, yeah, but I think as I do that, one of the most important things is not to get too over or underexposed to any one sector. I will take sector bets, but you got to be careful because you don't want to screen stocks and say, well, this is, all the attractive stocks, they appear in this one industry. I can remember about 7 years ago coming across a manager that I was looking at. We were just having a discussion, and he was a value manager, and he had 30% of his portfolio in energy stocks because that's where all the cheap stocks screened. And, he had a very tough several years, and then he had a great 21 and 22. That's not the sort of life that I really want to live. I will take sector bets, but not that big. Now, going back to the concentration, 25, what that really means is that you're going to have 1 to 3 stocks in any industry. And generally speaking, of those 1 to 3 stocks, you have to include the best in class. On the other hand, within those other 2 to 3, 1 to 2 stocks that fill out a sector, I will take a flyer or two, something where I'm looking and doing the analysis and saying, this is a stock that's worth much more than what it's selling in the public market. So what you're hearing from me is concentration and yet at the same time, risk management. I like doing that. I know plenty of managers, and Michael, you do too, who will hold 50, 60 stocks. And quite often they're really paying attention to what the benchmark weightings are, both in terms of sectors and in terms of individual positions. That's fine. I'm not taking any shots at that. Just the way I like to manage is to really do the analysis and say, I think this stock is tremendously undervalued, or I see opportunity in this sector, and then place a meaningful amount of money to it.
If you want to match the S&P 500, buy 500 stocks and you will match the S&P 500. Okay. If you're going to buy more than that, you could still match much more easily than if you buy 25 stocks. 25 stocks are not going to behave the same. Sometimes they're going to behave better. Sometimes they're going to behave worse, and you will have tracking error. And only through tracking error, meaning you're not tracking that index exactly, will you have the opportunity to outperform over time. And if I listen to Jim with the ears of an old portfolio manager. And when he talks about his core portfolio, what I just heard, and I want to ask him, that there's 20%, 20 to 25% of Jim's portfolio that he considers much more opportunistic than core. And that core is going to be the solid driver of that portfolio over time. And ideally those opportunistic names, and they're not going to be your main aisle at Walmart kind of names, folks. There are going to be a couple of names in there. You're going to go, what? what does that company do? But those are going to be the ones over time, still meet the same discipline because Lebenthal is a disciplined manager, but those are the ones he's looking to really drive the excess and the outperformance. Have I got that right, Jim?
Well, you've got it exactly right. And on those, off the beaten path names, folks, I'll still tell you, I mean, these are large cap names. These are not names that you're scratching your head saying, what are they? And I talk about them quite often on CNBC. I mean, the things that I would say are number one, I look at cash flows quite a bit. When I put my money or my client's money to work, I don't want to take undue risks. So I look at, are these companies generating positive free cash flow, meaning cash flow above and beyond that amount that's needed to run the business and service the debt. Then I look at the price that's being paid, because I don't want to buy a stock that goes down 20% over a short period of time. And a client calls me up and says, well, why did you buy that? And I say, well, the price felt good, but what did I really know? I want to be able to say that, look, I bought it at 6 times free cash flow, and that gives you a cushion, a margin of safety. These are the things that are important to me. But the flip side of what I just said is, quite often I miss out on the faddish, momentum-driven stocks. And I'm not taking shots at any sectors, but just as an example, right now, cybersecurity is very, very hot. And folks, I'm not recommending, it's just that the market sentiment could turn, and I don't want to do that for myself or for my clients. So the price I pay for those cash flows really matters to me.
Anything that goes up really fast, Lebenthal and I have learned over many years, can go down really fast. And there needs to be really there underneath. Cash flow is one of those very key theirs. So that if the sentiment turns, if something happens in the industry, do they still have a balance sheet? Do they have other products? Can they still, or am I in real trouble with this company? And if you're managing other people's money, you never want to be in real trouble with a company. I hope, Jim, as we do this, and we're out of time, we're actually over time, but this has been really great. I hope that people are listening. Ladies and gentlemen, you've got 2 experienced portfolio managers here who manage billions of dollars. And we just said, here's how we do it. We go with a core. It's a diversified core. We know our companies really well. We've got really solid fundamentals in the companies. These are what we strive for. We have a discipline to keep us safe from our emotions. And we at Farr Miller in Washington, and I know Jim does too, we exploit the great inefficiency of time. The market's new gnat-like time expectations for everything to happen on the next earnings call or the next quarter or the next this or the next that. And what did it do today? And how did it react? We don't care. We don't care. We sort of care. But what we really care about is how it does over the long term. And are they executing that business model that we reviewed and analyzed and on which we set our expectations for future growth? Because if the company grows and earnings grow and the cash flow continues to grow and management continues to execute, then the stock price will follow over time. That's our whole job. That's what we do. If it doesn't sound complicated, you're right. If you can do it and avoid those emotions and stick to your guns like Lebenthal did when everybody was bearish and he remained bullish, that's how you stay successful. Jim Lebenthal is a partner at Cerity Partners, a CNBC contributor, and my very dear friend. Thank you, Jim.
Michael, it truly is always a pleasure. Great to see you. Thank you.
Great to be with you. We're going to be back with Dan Mahaffee from the Dr. Scholl Foundation, Center for the Study of the Presidency Congress, the senior political analyst on the FarrCast. Please stay with us.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back. Joining us now, as he does every week almost, Dan Mahaffee, Vice Chairman of the Dr. Scholl Foundation, still involved with the Center for the Study of the Presidency in Congress, our senior political analyst on the FarrCast. Welcome back, Dan.
Thank you, Michael. Good morning and good to be talking to you.
Good morning. Good to be talking to you too, Dan. We have a 2-man race for the presidential office coming up here starting in November. We've got the big election day, and we're going to hear from these guys for the next 8 months. God help us. Feels like awful. 6 months, 8 months, awful. Anyway, you look at it. And we have other candidates. We've had things go on Capitol Hill. We've got TikTok. We've got a lot to talk about, even China. So let's start on Capitol Hill. A continuing resolution was passed so that the budget did not have to shut down. Dan, how'd that happen? And how'd they get it through? And how much currency did Speaker Mike Johnson have to spend?
I don't think Speaker Johnson had to spend all of that much currency because it was clear that they weren't going to get these spending bills done on schedule and that a CR was the only way, despite the protestations of the far right, the only way to get this done. So again, he's had to use Democratic votes to run the chamber because the Rules Committee is broken, but they got the CRs through, and we have that first set of appropriations done. They took the low-hanging fruit first; those are through. But we're really coming down. The next deadline is March 22nd, and from what I understand, the defense bill is ready to go. But some of the other ones, Homeland Security, other matters, there's still details being hashed out there. But we need to see those numbers soon, and it's going to be a lot of midnight oil, I fear, for the staffers on these appropriation committees to get that done by this deadline.
You hear a collective groan from the American people going, God, not again. Can they just stop it? Not again. And I think the answer is no, they can't just stop it. This is what they do now. Is that accurate?
That's fair. And I think also the American people have almost become inured to this kind of immune to this dysfunction in some ways, where they just don't follow this, and it's just seen as dysfunction as normal rather than business as usual.
The president got a pretty good bump from his State of the Union. Has it worn off already?
It has worn off already. If anything, the best part of the State of the Union for the president was that it shored up nervous Democrats and boosted his fundraising numbers. We haven't seen much of the State of the Union bridge across the partisan divide. I think that's one of the factors you're going to have to look at in this election is one, everyone's concepts, unless you're, truly one of those people who's been fighting World War II and stuck on an atoll somewhere, who Biden and Trump are at this point. If you're a voter, you can't escape. So as we discussed last week, it's going to come down to where do these people who dislike both candidates break? And I think there the challenge was, sure, he did show that he was more vibrant, he was more with it. Questions, though, about just how far left of a program Biden can push for with spending and other environmental priorities at a time when he's really trying to appeal to voters who might have soured on his economic record.
I still have such little patience for the folks who are, I don't know, ideologues who simply have to be 100% one way or the other and can't be thoughtful about issues of the day. I said on this program and also on social media that I thought the president did well in his State of the Union speech. I got torn apart by folks saying that he was old and doddering and angry and a grumpy old man, and it was worse. And somebody said that I went down several notches in their book and blah, 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 because when I play golf with someone and we're playing in a match and they hit a good shot, do you know what I say? I say good shot. I say good shot. I'm not thrilled about it. I'm not really happy that the guy's next to the pin in two because he's going to beat me. But I'll still recognize that it was a good shot. I'm not in, I even responded. I said, I'm not endorsing Joe Biden. I'm not saying I like his policies. I'm not saying anything other than this was such a low bar. My expectations for this speech were almost terrifying. And I think it's really a good thing when the president of the United States does well in any circumstance. In any arena, you want the president, whoever the hell the president is, to do well because you're an American and you want the president.
Yeah, Michael, that's the problem now. And forgive me for mixing metaphors. I'll follow you first. Most people don't care about the quality of the shot. I won't say most people. Let's put it this way: most politically active people no longer care about the quality of that golf shot. They care about whether the person hitting it was red or blue. That's the sad truth for the people who are in the hyper political part of our society. And as a result, I find then the most people, this is where we'll actually get to most people are tuning this out. When you have these conversations about Biden and Trump outside Washington, unless people have a strong opinion one way or the other, they mostly bow out. And to your point, the second metaphor I've always had is that when I'm in an airplane, I root for the pilot. And that's the way I feel about the president of the United States, that there's a certain amount of it you have to respect the office and respect what he did. Now, the policy questions, there's a lot of them between the two. And I think the sad part is on a lot of this, be it Israel, Ukraine, the state of our finances, the state of our education system, what's happening in our cities, even solutions for the southern border. None of that is going to be discussed when both parties, as we now see, are again going to have to be focusing on hiding the myriad flaws of their guy and trumpeting the flaws of their opponent.
And it goes beyond the criticism I got were personal. They were, you're an idiot, you're a bad person, I don't like you anymore. It got very personal very quickly. So I'm going to see if I can lash out with something that basically will just take you out at the knees too far. God, forgive you for saying anything positive about somebody I don't like. Okay, fine. But that's where we are, and it is very frustrating. Okay, Dan, Robert F. Kennedy Jr. Is a third-party candidate out there who's gaining some credibility and ground. I mean, the guy's not going to win, but he could be the Ross Perot spoiler out there. Who does he spoil? Does he spoil?
Well, look, he could be the Ross Perot spoiler. We don't quite know who the votes get taken away from in this point. Now, the other candidates I look at, you also hear like Cornel West coming in, and there, other more liberal candidates. And the only questions I look at those where, do they take 60,000 or 100,000 votes that would have either gone to Biden from a place like Madison, Wisconsin, or Ann Arbor, Michigan, or even, State College, Pennsylvania, the places where, frankly, students and activists are packed together in those areas. And will they vote for Biden at the end of the day, or will they stay home? Those are critical questions for Democrats in those states. And that's where I look at a Kennedy or any of these other third-party candidates playing a role. Is it the Buchanan example from Florida in 2000, where it's just, even some old Florida retirees just see Kennedy on the ballot and vote for it? I don't know what you have there as well. So look, it comes down to the margins in a tight election. Credibility, however, look, the latest I heard is that he is floating the idea of quarterback Aaron Rodgers as a running mate. And I'm not going to pour cold water on this simply because I'm a longtime Bears fan. I don't think when you're looking for a vice presidential candidate and you find out that he's on an ayahuasca retreat somewhere, I don't think that's really the way you look for your potential running mate.
I have heard that too, and it's if you're going to think you've got any kind of a serious shot, you need to get a little more serious here, sir. Okay, so there is a shot out there, and the more people I talk to, totally anecdotal, they're saying, I don't want to vote for either of these candidates. And I have held my nose and voted for any number of candidates over my lifetime. Really, and in recent years, I've had to hold my nose even tighter. And I think I might have closed my eyes last time in the voting booth on top of holding my nose. I feel more that way in this election than I ever have before. And people said, well, why don't you just write me in? Right? Let's all write in Mahaffee for president. And I'm thinking, great, I'll do it. But when I write in Mahaffee, is it any different than not voting? And if I don't do that, for whom am I actually casting a vote? Who's getting my support?
Right.
Who's getting my support?
And that's again, it's a question of where is your vote going in the end, and what state do you live in becomes, the quirks of the Electoral College mean what state you live in has an impact on the weight or value of your vote. So, look, if you live in Wyoming or California, you might be able to write in Farr or Mahaffee and not have it matter. A very different story if you're in an Arizona, Georgia, Michigan, Wisconsin, etc. The other thing too, I think we'll see is how much of the the questions of and this is what I want to see, the material that leads people to either not vote or look for a third candidate. How much of that are we going to see on social media pushed on Facebook, TikTok, and other things to make people confused, or how much do these third candidates play into election manipulation or disinformation? That'll also be interesting to see.
Right. Okay, let's shift now. We're out of time, Dan. Shift quickly and tell me, if you would, what's going on in China. Things seem to be continuing down a Xi Jinping rat hole.
Well, yeah, we saw that in the latest party Congress. It was very much an emphasis on Xi Jinping's policies, the no longer having the economic press conference given by the premier, the number two. Part of that's opacity on the numbers. Also, part of it is the Xi Jinping crackdown on economy or other sorts of power centers. Also, a lot of anger coming from China about what the House has done on this TikTok bill. Look, I don't think it has the clearest path in the Senate, but we'll see after it moved so quickly through the House. But the Chinese see this as a big part of the tech conflict with the United States, both TikTok as well as how we've been working with other countries to really tighten up the semiconductor restrictions. So keep an eye on TikTok. I don't think that legislation is going to move quickly through the Senate, but it does tackle the foreign ownership issue of that company. And I think you'll see a struggle over these technologies, be it the semiconductors or the algorithms that run these platforms between the U.S. and China. That's only going to heat up, particularly with the rhetoric in the election year. I do think, though, it's really self-defeating when you have something like Biden coming out today, an ally like ours in Japan, and saying that Nippon steel should not take over U.S. steel. I don't know how you can say we're stronger with allies when you fall back on that kind of election year protectionism.
Dan Mahaffee, Vice Chairman at the Dr. Scholl Foundation, Center for the Study of the Presidency, Congress, and our senior political analyst on the FarrCast. Thank you, Dan. We always learn so much. Ladies
You're
and
welcome.
gentlemen,
Thank you, Michael.
back. Oh, well, yes, indeed, sir. Always, and thank you. We're coming back with Michael Singleton, senior analyst and founder of Invictus Research, and we're going to talk economics as we cover more on the FarrCast of Wall Street, Washington, and the world.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. I am Michael Farr. Here we are coming into middle of March, end of the first quarter of 2024 is right there in front of us. Just a couple of weeks, folks, and the first quarter is in the books. Can you believe that? Time is flying. Markets are doing great. Stocks are doing great. The economy is doing pretty well, too. The rate of inflation is slowing, but as folks who go to the grocery store will tell you, prices are still edging up on things here and there. Among those things on which prices are heading higher is insurance, homeowners insurance, health insurance, lots of insurance costs. And when you think about claims from storms and anything like that, let's say you have an insurance claim on your house. When you go and have to buy lumber and labor, all of those things are more expensive, and the insurance industry says we're just pricing it our way. But of course, if it's insurance, they have to have a little bit of a margin in there, and they diversify risk over a large group of people. Yeah, that's the idea, but prices are going up. And Fed Chairman Jay Powell was talking about that lately. Where are costs going? And if you're spending money on insurance, folks, you're not spending money at the grocery store. You're not spending money on new cars. And consumer spending, retail sales were a little bit weaker, even though prices came in a little bit hotter this week. So prices continued up, and that probably means that the Fed is not going to cut rates, in Farr's opinion, anytime soon. And perhaps they have engineered a soft landing. And if the Fed gets this right, folks, if the Fed gets it right, arguably they shouldn't have to do a thing. They took rates to exactly the correct level, and unemployment stays low, and we get a lower, slower rate of inflation and continued expansion of the economy. And why do they need to change anything? That's what I said to Pat Harker. That's what I said to Pat Harker 3 weeks ago at University of Delaware as we talked to the economic forecast. Pat and I have done this for years, and I've done it for 16 years with one Fed president or another. Been a great honor to do that. So joining me now, Mike Singleton is a CFA, senior analyst and founder of Invictus Research, macro firm. He's been a money manager as well. Summa cum laude from University of Notre Dame. My brother-in-law loves you already. He now thinks you're brilliant, no matter what you say. And by the way, in finance and theology. So if it doesn't work out in the economy, he can pray about it. That's something a lot of economists don't have in the dismal science. Michael, welcome to the FarrCast.
It's my pleasure. Thank you for having me.
We're very glad you're here, and we look forward to learning a whole lot from you this morning in a few minutes. I suggested that if the Fed has it right, they don't have to change rates at all. And given what we're seeing in the economic data, why should they change?
It's a good question. Well, I guess the framework that I use when thinking about policy is not so much normative as it is positive. And what that means is I don't spend a ton of time thinking about what I think the Fed should do. And the reason is because no one cares what I think the Fed should do. And I'm sure that I would disagree with Chair Powell and all the other policymakers about everything. But I think my clients would probably fire me if I talked to them about what I think the Fed should do. I try and focus on what the Fed will do, given the different mental models and frameworks that they've laid out, and given the incentives that they have in place. And I actually think this year, I think the Fed will almost certainly cut less than the markets anticipated coming into this year. That said, I think that the Fed probably will cut. And I think one of the reasons that I have some confidence in that is when Chair Powell was speaking earlier this week before, I think it was the Senate Banking Committee or the House Financial Services Committee, I can't remember which one, but he said with a lot of confidence in front of Congress, in front of listeners from around the world, that the Fed would affirmatively start cutting at some time in 2024. And he's also said many times in past press conferences and other speeches that he's given that he does not want to wait until inflation is at 2% before he starts cutting the nominal Fed funds rate, right? And so my expectation is, I think there's a temptation for a lot of investors to not listen to what the Fed is saying or to try and overly read between the lines. And I actually think that if you understand that the models that the Fed is using, for example, the neutral rate model is a model that Chair Powell references a lot, that actually is an edge in terms of anticipating what the Fed will do. And I use the word anticipating very intentionally because I don't really think it's about forecasting. I don't even think the Fed really bothers to forecast so much anymore. It's about anticipating where the weight of the risks lie. And I think given the economic circumstances, and I think given how Chair Powell thinks about the economy and the rest of the FOMC, at least one cut is probably on the table for this year.
I can hear some of our listeners, and I'm just going to be argumentative because, I don't know, I'll be argumentative this morning. Listeners are going to say, hey, what didn't Fed Chair Powell also say that inflation was transitory? Isn't he the same guy who kept saying transitory over and over again? And couldn't he change at some point in the future? So my only point there, Michael, is that he doesn't get everything right, of course, but I tend to agree with you that perhaps if not for substantive reasons, at the very least for political reasons, meaning if they don't ease a little bit, you've got one side of the aisle that's going to be screaming bloody murder that the Fed's standing up and standing in their way of reelection. And if they ease more than maybe once and possibly a second ease towards the end of the year after the election, and that I don't necessarily think will happen, that the other side will scream that, the Fed's trying to get the incumbent reelected. So they're walking that political tightrope and probably have as their priority maintaining the independence of the Fed and avoiding further attention from all these politicians if they possibly can. Does that make sense to you? And given what you think they may or may not do, it sounds like with just very few cuts that your view on the economy is bullish.
So first, I'll concede that the Fed is terrible at forecasting, and when they're talking about the future, they get things wrong a lot. I definitely would not debate that fact. Second, is there a political incentive? I think the answer is yes, and I think you can be pretty confident in that because President Trump has said, as recently as I think a month ago, that if he's reelected, he'll fire Jay Powell. And so whether you think Chair Powell will act on that or not, clearly there is an incentive for Chair Powell to influence the economy in a way that, doesn't favor President Trump. And so I'm not saying that will happen. Personally, I think it probably does not happen, but you have to acknowledge that that incentive exists. And so it creates sort of a downside risk in terms of monetary policy. In other words, a risk that the Fed eases more than the market expects, which would be an upside risk for, say, the stock market. In terms of the economy, you're right. I think that when I say the economy, I think the economy is doing well or it's strong. I can be a little bit more specific. I think that the economy is reflating. And what I mean when I say that is that real economic growth and inflation are going to accelerate at the same time over the coming months and quarters. So if the economy is growing 5.5% right now nominally, I think that we have reasonable line of sight into 7%, 7.5% nominal growth by year end. And that's a very good backdrop for financial markets historically. It's a backdrop where stocks generally earn 20% plus returns, which sounds dramatic. That's just what history tells us. And there are, of course, confounding variables within this conversation. But markets are not irrational. Markets generally trade on the economic fundamentals. And right now, the most important economic fundamentals in terms of momentum, in terms of the sequencing of the business cycle, really in terms of growth and inflation, and Invictus, we think they look positive.
So in our first segment today, ladies and gentlemen, Jim Lebenthal was saying that he liked to buy companies certainly with strong cash flow and positive fundamentals. And he didn't see a real earnings recession without an economic recession. As long as the economy continues to expand at some rate, he was fairly constructive on stock price performance as we look ahead. And if you listen to what Mike Singleton is now telling us, he also expects that we're going to have this continued economic expansion on the back of which we will see and should see historically positive stock returns, barring the unforeseen. One of the things we talk about, Mike, is that bull markets never die of old age. They're always killed, and they're most often killed by some misstep on the part of the Federal Reserve. So if the Fed were to make a mistake in the next 12 months, if it could be a fatal mistake for the bull market, what would it look like and when would it come?
I think that the fatal mistake that the Fed usually makes at the end of economic cycles is that they tighten policy too quickly and then they hold policy too tight when the economy is turning lower. And I think the risk of that is very low right now. Now, don't get me wrong, I spend a ton of time thinking about monetary policy and analyzing monetary policy and trying to anticipate monetary policy. But monetary policy is not the only thing that matters. The United States still has a relatively free economy, a relatively free market. It has a very, very large private sector relative to the rest of the world. And the underlying momentum in the private sector is generally what drives economic outcomes, not monetary policy, except in the event where the Fed is taking rather dramatic action, which is usually when, one, inflation is high, and two, they're telling you that they're going to take dramatic action. They're usually not shy about it. In fact, the way that Fed policy works right now, they can't be shy about it. They really have to talk about it. And communications is one of their primary tools for enacting Fed policy. So I think that the risk of that is relatively low right now. And the risk is further reduced by the fact that the federal government is continuing to run very large deficits. And if you look at the projections of the CBO or the OMB, they have no intention of bringing those deficits back down to their historical levels. So you have sort of a benign monetary policy backdrop, a very favorable fiscal backdrop, at least in terms of the short to intermediate term. And then you have a private sector that is gaining momentum by the month, by the quarter. So combine all that together, and it's a very positive backdrop for stocks.
Two things I want to cover and clarify before we go, and I can't believe we're out of time, but we are. This has been fascinating. When it flies by, my producer Harry Jennings will tell you when he looks up and goes, "Oh my God, that was 12 minutes! I can't believe it." Those are really good segments. Now you have to be a little bit wonky, a little bit economist on this. And some of our listeners go, "Why do you spend so much time on the Fed? Why do you spend so much time on policy and the economy?" Because it is the tide that will lift or lower all the boats. So one of the things Michael said, he talked about nominal growth of 5 to 7%. He's talking about in the overall economy for GDP growth. And he said nominal growth, which is different from real growth. And real growth is going to be that nominal growth minus the rate of inflation. Minus the rate of inflation. So what do you really get to keep? If I tell you that you're getting more in your paycheck, and you probably are because wage growth has been going up, you say, great, I've got 10% more in my paycheck now than I had 2 years ago. Great, good for you. But if the prices at the grocery store have gone up 10%, the hell difference does it make? You're not buying anymore. Things aren't getting any better. This is just sort of a shell game. So we pay attention to that real rate versus nominal rate. The difference in your paycheck versus the difference at the grocery store is what we look at for the broad economy from a big macro sense too. Even under Michael's forecast right now, if we got to 7% GDP growth, which would be a big number, at 3.5% inflation, which I think is probably an okay target, Michael, you would have 3.5% economic growth, 1.5 above the Fed's 2% target. We don't know what's okay to the Fed, but that's probably still on the hot side. Would you agree with that?
I do agree with that. I think inflation can actually be closer to 4% by year end. And I think if you actually look at the annualized data, month over month data for January and then for February for CPI, and you can look at CPI or PCE, it's already consistent with close to 4% inflation. So if data like that persists, the year over year data is going to start to converge with that annualized data. And that's really our base case right now.
So now, finally, you said that fiscal policy was good. And that's the policy, ladies and gentlemen, that's coming out of the Treasury Department and out of Congress and how they're spending money. Monetary policy, of course, is what the Federal Reserve does. And the Federal Reserve isn't doing much right now other than talking. And that's not bad ever. If you can it's when they start moving that you have to hang on to your wallet. So, but the fiscal side, that federal government side, that Treasury Department side is spending a lot of money. Last year, they spent $1.5 trillion more than we brought in as a country. We had $4.4 trillion in receipts. We spent $6.1 trillion. It was $1.7 trillion more. We spent $0.5 trillion more. We spent $0.5 trillion in deficit spending in the fourth quarter alone. Michael, we have $34.5 trillion in U.S. debt, and that's supposed to go to 40 trillion, certainly over the next 5 years. How is that a good thing? And why doesn't this get to be a big problem? And service on the debt's going to be next year forecasted to be bigger than the defense spending in this country. When does this get to be a real problem? And I only have 45 seconds for your answer. Sorry.
Okay, I'll be quick. So I think it's important to distinguish between the long-term and the shorter-term implications of loose fiscal policy. The short-term implication is generally faster economic growth and faster inflation and higher interest rates.
Yes.
Right. And actually, there are a couple of accounting identities that show higher fiscal deficits translate pretty directly to higher corporate profits, which is also good for stocks. Now, over the long term, large fiscal deficits and high debt to GDP generally translates to lower long-term economic growth. But one way to think about it is kind of like nutrition for an individual, right? There are a lot of things that taste good in the short term, but aren't good for you long term, and therefore should be indulged in sparingly. I think that's a reasonable analogy for fiscal deficits.
So short term, good. Long term, we got a problem and we're going to have to figure out how to deal with it. And nobody wants to deal with it, ladies and gentlemen. Nobody wants to deal with the long-term problem, least of all the politicians. So we will continue to watch the short term as things likely drift higher. We'll watch out for the long term to see when this abiding and increasing consequence begins to put pressure on share prices and other economic growth. It always looks a little bit further in the future until it isn't. Certainly learned a lot, Michael. Thank you for joining us. Michael Singleton is senior analyst and founder of Invictus Research. I think you ought to read it, and I think you ought to listen to this guy. He's a smart one. Michael, thank you.
Thank you again, Michael.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world here just before the Ides of March in 2024. And we got a new FarrCast for you next week, bringing you insights to help you figure out the world and your investment portfolio and how we can be better thinkers, critical thinkers, and understand the world around us a little bit better. For Hightower Advisors, Farr, Miller in Washington, my producer, Harry Jennings, thank you so much. Please share us on your social media. We'll be back next week. Have a great weekend. Oh, and ladies and gentlemen, happy St. Patrick's Day. That's going to be on Sunday, you know, St. Patrick's Day. It's one of my favorite days of the year. I'm going to go to Washington to celebrate with the Society of the Friendly Sons of St. Patrick on Saturday night. I hope to see many of you there. Aaron Gobra.
Thanks for being with us this week on the FarrCast. We hope you enjoy the show as much as we enjoy making it for you. Thanks to our guests this week, Jim Lebenthal, Dan Mahaffee, and from Invictus Research, Mike Singleton. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Google, Spotify, TuneIn, and Apple Podcasts. You can stream past episodes as well as subscribe so you never miss a new one. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, a news headline, or an economic trend, it's not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. As always, if we can be of assistance at Farr, Miller in Washington, please feel free to reach out to me at hjennings@farrmiller.com. We're here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We love reading all of your notes, and we try to respond to as many as we can. You can reach us at hjennings@farrmiller.com. Let us know any questions you have about past episodes or questions you'd like us to address in upcoming shows. Please subscribe and share the show, and we'll be back with you next week. Take care, stay safe, stay healthy. Thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller in Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.